Most people will save or lose a few $100s this year, not because of anything they did wrong, but because the IRS quietly changed the math. The 2026 tax brackets moved, the standard deduction jumped, and Congress passed the One Big Beautiful Bill, which brought in new tax breaks and removed some familiar ones. Here's what changed from 2025 to 2026 and what it means for you. Every year, the IRS adjusts the tax code for inflation, but 2026 adds a major twist. The One Big Beautiful Bill made the Trump-era tax cuts permanent and added several new deductions for individuals. That means 2026 isn't just another routine adjustment. It's the most significant one since 2017. Let's start with the tax brackets. The rates themselves didn't change, but the income thresholds did. For single filers, the 22% bracket now starts at roughly $50,400. For married couples filing jointly, it begins around $100,800, and for heads of household, it's somewhere in between. The top 37% rate now kicks in at above $640,600 for single filers and $768,700 for married couples. In practical terms, if your income rose by around 2% last year, you'll likely stay in the same bracket instead of being pushed into a higher one. Standard deduction also grew. For single filers, it's now $16,100, up from $15,750. Married couples filing jointly can now claim $32,200, up from $31,500, and heads of household can take $24,150 compared to $23,625 last year. These small bumps mean a bit more income remains tax-free. Seniors get an extra bonus. Taxpayers age 65 or older can now claim an additional $6,000 per person through 2028, giving married senior couples up to a $12,000 deduction boost. The One Big Beautiful Bill also introduced several new above-the-line deductions that directly reduce your adjusted gross income. The no tax on tips provision allows workers in tipped industries to deduct up to $25,000 of reported tips, though it phases out at higher incomes. The no tax on overtime deduction lets you deduct up to $12,500 in overtime premium pay if you're single, or $25,000 if you're married filing jointly. Finally, there's a new car loan interest deduction, up to $10,000 for new U.S. assembled vehicles, again, with income limits. These deductions apply from 2025 through 2028, so they're temporary, but potentially very valuable. Several credits were expanded or adjusted. The child tax credit increased from $2,000 to $2,200 per child and will now rise automatically with inflation. The child independent care credit now covers up to 50% of qualifying expenses, and the income thresholds for phasing out the benefit are much higher, making it more accessible for middle-income families. Meanwhile, the SALT deduction cap for state and local taxes jumped from $10,000 to $40,000 and will stay indexed through 2029. This is huge news for taxpayers in high-tax states like California, New York, and Illinois. Some credits disappeared after 2025. The electric vehicle and green energy credits are gone for 2026 purchases, and the moving expense deduction remains only for active duty military members. Before you file, there are a few things to check. Compare itemizing versus taking the standard deduction as the thresholds changed. If you earn tips or overtime, keep good records to claim those new deductions. If you're 65 or older, don't forget the bonus deduction. And if you're in a higher income bracket, enjoy the larger SALT cap, but be mindful of deduction limits. In short, your 2026 taxes look a little friendlier than 2025's. Brackets moved up, your deductions grew, and the One Big Beautiful Bill added several temporary perks worth claiming. If you earn tips or overtime, track them. If you're married, revisit your withholdings as the tax code just quietly handed you a raise. If this breakdown helped you make sense of what's changing in 2026, hit the like button, subscribe to the channel, and share this video with a friend who could use a little extra tax knowledge this season. Stay smart, file confident, and I'll see you in the next one.